Are you worried about the next economic downturn? Do you want to know what causes recessions and how they happen? Well, you're in the right place. In this video, we're going to dive deep into the world of recessions and uncover what they are, how they happen, and what you can do to prepare. So, sit back, relax, and let's get ready to understand recessions like never before. To start with, let's talk about the definition of recession. A recession is a significant decline in economic activity that lasts for a sustained period of time. This is typically characterized by a decrease in gross domestic product, GDP, employment, and income. In other words, when the economy experiences a significant contraction, and businesses start laying off workers, and people start losing their jobs, it can lead to a decrease in the overall income of the population. As a result, people may start spending less, which can lead to a decrease in economic activity across the board. It's important to note that not all economic contractions qualify as a recession. To be officially considered a recession, the contraction needs to last for at least 2 quarters or 6 months. The Great Recession of 2008 to 2009 is a great example of a recession. It was a severe contraction in the global economy that lasted for about 18 months. During this time, businesses went bankrupt, housing prices plummeted, and millions of people lost their jobs. As you can see, recessions can have significant negative impacts on individuals, businesses, and the overall economy. So now that we've covered the definition of recession, let's dive deeper into what causes recessions in the first place. The causes of recessions. Recessions can be caused by a variety of factors, including financial crises, external shocks, such as natural disasters or wars, changes in monetary or fiscal policy, and shifts in consumer or business confidence. One of the most common causes of recessions is a financial crisis. A financial crisis can occur when there is a sudden loss of confidence in the financial system. This can lead to a collapse in asset prices, such as housing prices, and a reduction in lending by banks, which can ultimately lead to a decrease in economic activity. External shocks, such as natural disasters or wars, can also cause recessions. For example, the oil crisis of the 1970s was caused by the sudden rise in oil prices following the Arab-Israeli War. This shock led to a decrease in economic activity as people had to pay more for oil, leading to a decrease in spending on other goods and services. Changes in monetary or fiscal policy can also cause recessions. For example, if a central bank raises interest rates to combat inflation, it can lead to a decrease in borrowing and spending, which can ultimately lead to a decrease in economic activity. Shifts in consumer or business confidence can also be a cause of recessions. If people or businesses become more pessimistic about the future of the economy, they may start spending less and saving more. This can lead to a decrease in economic activity, as less money is being spent on goods and services. It's worth noting that recessions can be caused by a combination of factors. For example, the Great Recession of 2008 to 2009 was caused by a combination of a financial crisis, changes in monetary policy, and shifts in consumer and business confidence. So now that we've covered what causes recessions, let's talk about how we can predict when a recession might occur. The business cycle. In the previous segment, we talked about the causes of recessions. In this segment, we're going to dive deeper into the business cycle. The business cycle refers to the natural rise and fall of economic activity over time. The business cycle is characterized by 4 different stages: expansion, peak, contraction, and trough. During the expansion stage, economic activity is growing, and employment, income, and consumer confidence are all increasing. This is a period of economic growth, and it typically lasts for several years. The peak stage is the point at which the economy reaches its maximum level of growth. After this point, economic activity begins to slow down. During the contraction stage, economic activity begins to decline. This is the period in which a recession typically occurs. Employment, income, and consumer confidence all start to decrease during this stage. The trough stage is the point at which the economy reaches its lowest point. This is the period in which the recession is at its worst. After the trough stage, the cycle starts all over again with the expansion stage. It's worth noting that the length of each stage can vary, and not all business cycles are the same. Some cycles can be short and shallow, while others can be long and deep. Economists use a variety of tools to measure the business cycle, including gross domestic product, GDP, employment data, and consumer spending data. By analyzing these indicators, economists can predict where the economy is in the business cycle and when a recession might occur. What are economic indicators? In the previous segment, we talked about the business cycle. In this segment, we're going to talk about economic indicators. Economic indicators are statistical data points that provide information about the state of the economy. They can be used to measure things like economic growth, inflation, unemployment, and consumer confidence. Some of the most commonly used economic indicators include gross domestic product, GDP, the consumer price index, CPI, the unemployment rate, and retail sales. GDP is the total value of goods and services produced by a country in a given time period. It is considered to be one of the most important economic indicators because it measures the overall health of the economy. The CPI is a measure of inflation, which is the rate at which prices for goods and services are increasing. This indicator is important because inflation can have a major impact on the economy and the purchasing power of consumers. The unemployment rate is a measure of the percentage of people who are unemployed and actively seeking work. This indicator is important because high levels of unemployment can be a sign of economic weakness. Retail sales are a measure of the amount of goods and services sold by retailers. This indicator is important because consumer spending accounts for a large portion of economic activity. Other economic indicators include housing starts, industrial production, and consumer confidence surveys. By tracking these economic indicators, economists can better understand the state of the economy and predict where it may be headed. This information can be used to make decisions about things like monetary policy, fiscal policy, and investment strategies. The impact of recessions. In the previous segment, we talked about economic indicators. In this segment, we're going to discuss the impact of recessions. Recessions can have a significant impact on individuals, businesses, and the overall economy. Here are some of the ways in which recessions can affect us. Job loss. During a recession, businesses may cut jobs to reduce costs. This can lead to higher unemployment rates and a reduction in consumer spending. Reduced income. As more people lose their jobs, the demand for labor decreases. This can lead to lower wages and reduced income for those who are still employed. Decreased consumer spending. As people lose their jobs or see a reduction in their income, they may cut back on spending. This can lead to decreased sales for businesses and a further slowdown in the economy. Business failures. During a recession, businesses may struggle to stay afloat. Those that are already in debt may be forced to close their doors, which can lead to more job losses. Stock market decline. The stock market tends to reflect the overall health of the economy. During a recession, stock prices may decline as investors become more cautious about the economy. Decreased government revenue. During a recession, tax revenue tends to decline as people and businesses earn less income. This can make it difficult for governments to fund public services and may lead to budget cuts. Increased debt. During a recession, governments may need to spend more money to stimulate the economy. This can lead to an increase in national debt, which may have long-term consequences for the economy. The government's response to recessions. In the previous segment, we talked about the impact of recessions. In this segment, we're going to discuss the government's response to recessions. When a recession occurs, governments often take action to try to mitigate its effects. Here are some of the ways in which governments can respond. Fiscal policy. Fiscal policy refers to the government's use of taxes and spending to influence the economy. During a recession, governments may increase spending or reduce taxes to stimulate the economy and create jobs. Monetary policy. Monetary policy refers to the actions taken by a central bank to influence the money supply and interest rates. During a recession, central banks may reduce interest rates to encourage borrowing and investment. Government aid. Governments may provide aid to individuals and businesses affected by a recession. This aid may come in the form of unemployment benefits, grants, or loans. Infrastructure spending. Governments may invest in infrastructure projects, such as road or bridge construction, to create jobs and stimulate economic activity. International cooperation. During a global recession, governments may work together to coordinate their responses and stabilize the global economy. While government action can help to mitigate the effects of a recession, it's important to note that these actions may have long-term consequences for the economy. For example, increased government spending during a recession may lead to higher national debt and inflation. Recovery plan. In the previous segment, we talked about the government's response to recessions. In this segment, we're going to discuss the recovery plan. A recovery plan is a set of policies and actions taken by governments and businesses to restore economic growth and stability after a recession. Here are some of the strategies that may be included in a recovery plan. Investment in education and training. During a recession, Many people may lose their jobs. Investing in education and training programs can help individuals acquire the skills they need to find new employment. Infrastructure projects. Investing in infrastructure projects, such as road or bridge construction, can create jobs and stimulate economic activity. Tax incentives. Governments may offer tax incentives to encourage businesses to invest and create jobs. Regulatory reforms. Governments may also implement regulatory reforms to make it easier for businesses to operate and create jobs. International cooperation. During a global recession, governments may work together to coordinate their recovery efforts and stabilize the global economy. Monetary policy. Central banks may continue to adjust interest rates and other monetary policies to support economic growth. Consumer confidence. Restoring consumer confidence is crucial for economic recovery. Governments and businesses can work to restore confidence by providing accurate and transparent information about the economy and taking steps to address concerns. It's important to note that recovery from a recession can take time, and the success of a recovery plan depends on a variety of factors, including the severity of the recession and the effectiveness of the policies implemented. Thanks for watching. We hope this video has given you a better understanding of recessions and how they happen. If you found this video helpful, don't forget to give it a thumbs up and share it with your friends. And if you have any questions or comments, feel free to leave them down below. Until next time, stay informed, stay curious, and keep learning.